So Privia Health just dropped a fantastic quarter. I mean, they beat expectations on every single key metric, and they raised their guidance for the year. So why on earth did the stock get hammered? That's the puzzle we're going to unpack today. Let's get into it.
Seriously, on the surface, this makes absolutely zero sense. You've got Privia Health delivering a massive beat on revenue, a massive beat on earnings, and they raised their guidance for the rest of the year. So the big question, the one we really need to answer, is why? Why did a stock with a report this strong end the day down over 4%? It's a real head-scratcher.
Okay, to understand this whole puzzle, we first have to appreciate just how strong this quarter really was. Let's take a look at the headline numbers and see how they stack up against what Wall Street was expecting.
And wow, the numbers really do speak for themselves here. Revenue came in at over $580 million. Now, the consensus estimate was way down around $498 million. So that's not just a beat, that's a 16.5% crushing of expectations. Then you look at the bottom line, adjusted earnings per share at 29 cents, blowing right past the 22 cents analysts were looking for. I mean, that is a clear, undeniable win on both fronts.
But hang on, because the story gets even better when you look at profitability. Adjusted EBITDA, which, is a really key measure of their operating profit, it's surged by nearly 62% compared to last year. This isn't just growth, this is powerful operating leverage in action. It means their profits are growing way faster than their revenue is, and that's the dream, right? So, where did all this incredible performance come from? What's the engine behind all this? Well, the answer is Privia's secret sauce, their execution in what's called value-based care, or VBC. The idea is pretty simple. Doctors get paid for patient outcomes, for keeping people healthy, not just for the number of visits.
And the absolute star of the show this quarter was the Medicare Shared Savings Program, MSSP for short. Now, the deal here is simple. If previous doctors provide really high-quality care that costs less than what Medicare expects, Medicare shares a chunk of those savings back. And boy, did they save money. Previous networks generated over $234 million in total savings. And of that, previous doctors and the company itself took home a gross share of over $160 million. This was the engine that powered the entire quarter. And you could just feel the confidence coming from management on their earnings call. The CEO, Parth Mehrotra, he directly linked this outstanding performance to their decision to raise the forecast for the entire year. To them, this isn't a fluke. It's a sign of real, durable strength.
So the message coming from the C-suite was simple. We are firing on all cylinders. They highlighted great performance everywhere, they raised their outlook, they pointed to a smart new acquisition to fuel growth, and they really emphasized that their model is diverse and resilient. That's the story the company told.
Okay, so the company told a great story. But this is where we see that major disconnect. Because despite all the fantastic news, all the bullish commentary, Wall Street's reaction was, to put it mildly, pretty confusing.
Before the market even opened, everything looked awesome. The stock was up over 6% in pre-market trading, exactly what you'd expect. But then, the regular session started and it's like a switch flipped. The sellers came out in force, pushing the stock all the way down to close with a loss of 4.2%. Just a complete and brutal reversal.
And this right here captures that central conflict perfectly. On one side, you've got management painting this picture of sustainable, long-term growth. On the other side, the market's reaction just screams skepticism. See, investors, they tend to worry that these huge shared savings payments are lumpy or just really hard to repeat, especially as the goals get tougher each year. They seem to be betting that this massive beat was just a one-time thing and that these high margins just aren't going to stick around.
So we have the beat and we have the sell-off. And that brings us to the crucial part of our whole analysis. What do we think happens next, and where's the opportunity?
All right, so here's our thesis, and it's built on three main pillars. First, we think the market is just being way too pessimistic here, and it's totally underestimating how durable Privia's performance is. Second, the company's financials are absolutely rock solid. And third, they just made a key acquisition that gives them a really clear path for future growth.
Let's start with that financial strength. I mean, we're calling it a fortress for a reason. Privia has zero debt. And after their latest acquisition, they are still sitting on roughly $410 million in cash. They're also a cash-generating machine, converting over 80% of their earnings into free cash flow. This gives them immense flexibility to invest in their own growth without needing to borrow a dime. And that brings us to the catalyst, the recent deal to buy Evolent's ACO business. Now, this isn't just about adding over 120,000 patients to their platform, it's a really strategic beachhead. It gives them a lighter touch way to enter 6 new states, which they can then build upon with their full platform over the next few years. It's a very smart move.
So you put it all together, and our view is that the market just got this one wrong. That's why we're initiating coverage with an outperform rating on Privia Health.
We believe this sell-off has created a really compelling buying opportunity. The path forward seems clear to us. As Privia keeps delivering strong results and successfully integrates this new Evolent business, we expect the market is going to be forced to reevaluate its skepticism, and that should lead to a higher stock price. The key risk, of course, is always execution, but the potential reward from here looks very attractive.
And a final and very important note, this is not financial advice. Please be sure to conduct your own research before making any investment decisions.